Yeah, for us, the central theme as regards Nigeria and as it concerns Nigeria stems largely from how the oil price plays out. And from what we can see today, and I mean coming into 2019, we're having a situation of increasing oversupply against a weakening demand. So if you put those two things together, what it tells you is that the oil price outlook for 2019 is not that great. And coming off the back of that, Nigeria is heavily dependent on the oil price. It accounts for a significant part of our export earnings. It accounts for a significant part of government revenue. You know, so if an unfavorable oil price would impact Nigeria very, very badly. So it is from that view that we are thinking that a couple of things would happen. One, government would not be able to raise as much revenue as it plans to. It would affect budget spending. And then it will be forced to maybe shoot up its borrowing agenda for the year if we don't achieve those marks.
If that's going to happen, do you think that's going to happen more on the domestic front, or we're going to see more foreign borrowing?
I think probably a balanced across both, but definitely you're still likely to see that borrowing go up if the government is unable to meet its revenue targets. And then more critical, if the oil price remains very weak, it might begin to affect our current account balance, and that has implications for our
what we've read so far about the outlook for oil, rising inventories, low, weak demand, is that already playing out, or are there still more of forecasts at this point?
Oh, it's playing out already. It's playing out already. And I'll just cite examples. As you could see, globally, everyone is expecting weaker growth from China. China is a big consumer of oil. I mean, you heard what happened to Apple's results warning, and also it goes to show how things are slowing down in that economy. And if you have a slow China, it's going to affect oil demand across. Because China is linked to many countries in this world via trade, an impact on China, slower growth in China would also have ripple effects on other economies as well. So it's from that perspective we are looking at it from. Plus, the U.S. is producing at record levels currently. The balancing act will be how well OPEC is able to react to this emerging oversupply and weakening demand scenario.
Well, they have taken that first step, shutting in, reducing production. Nigeria already has its own cut. You don't think that this time that strategy could work? I
think people question how effective OPEC reaction would be, how effective based on the stance. And I'll give you an example. Nigeria is looking to meet a budget, particular budget. How do you expect that the impact of keeping production capped at a particular level? So compliance will be something that people would need to worry about with the OPEC decision to cut production.
What about currency? For the Naira, you're also projecting that we might see a weakening of the Naira, but that the CBN may. How long do you think the CBN could hold the line on the currency before we do see a pushback, as it were?
I don't think. I think the CBN has enough firepower to go through the next 6, maybe 9 months. But if the oil price remains weak after that time, I think we'll begin to come under some severe pressure. That is why we are forecasting a mild depreciation in the currency to around the 380, 390 levels. But that will probably happen at the end of the year if the oil price scenario plays out as we are expecting. But I think between now and probably till first 9 months, the CBN is good. They can meet.
So for an investor who is listened to looked at all the pros and cons, looked at all obviously the headwinds, politics, lower oil prices, revenue pressure, the possibility of higher borrowing, how does that investor, or how should that investor begin to approach the Nigerian market, either from the equity side, a fixed income? What would you have what do you think these investors are going to do?
Okay, from our perspective, we had looked at the environment and say, if the central bank is going to keep the currency stable, if it's going to maintain because when we look at it for this year, a lot of policy would have to fall, a lot of the reaction to the external environment would have to fall on the central bank. Because of the politicking around the elections, we don't transit into a new term until May. That is almost half the year gone. So you would expect that the central bank will have to do a lot using monetary policy, to try and react to these external factors. So
how much more? I'm just thinking to myself. We saw because I had that conversation last year. How much deeper how much deeper can the CBN, the MPC go in its toolbox? I mean, we saw this, I mean, the intervention schemes. What else can the MPC do at this point?
So we think there's not a lot to do. Not a lot to do. The MPC is almost at a very tight threshold. But I think the central bank can continue to use liquidity sterilization to control a lot of things. So that's why we think interest rates will remain relatively high. So feeding into this view of what the investment landscape will look like for 2019, we think it is more a fixed income play, because if we expect to see a protracted high interest rates environment, what it tells you is that the appetite for equities won't be as great. So that's how we're seeing it. But even within the equity space, if we're going to play that space, I think a focus should be on companies that give you some level of correlation with interest rates. For example, I'll point out some of the top tier banks that have very liquid balance sheets, have got their funding right. Those kind of banks make a lot of money when in a high interest rate environment. So those kind of banks would definitely report strong earnings.
I assume you're probably referring to the tier ones,
yeah,
mostly the tier one banks.
Yeah, mostly.
Now, I mean, you talked about. Let me take you to the the U.S. Fed. We talked earlier about how we could see more rate hikes this year, and you talked about the fact that fixed income is going to be a fixed income play this year, higher yields. But what if we do see the Fed raising maybe as high as three times this year? We see higher yields in the U.S. Don't you think fund managers would look at those yields in the U.S. and say, you know what, at least it's safer here compared to some emerging markets?
They already did that in 2018. Yeah. So, but I think the sense we are getting is that the U.S. Fed is under a lot of pressure not to tighten as fast as it had hoped. But even at that, we still think the markets were pricing in a 4 to 5 rate hikes this year before. But if we still see 3 rate hikes, I think it's still tough enough, given the situations. But people will worry more about the weaknesses coming out of emerging markets. Like you mentioned earlier, the World Bank is forecasting lower growth across the world, which we think will happen. A lot of that will stem from developed markets and flow into emerging and frontier markets. So in a weaker growth environment, I think the question many investors will be asking is, have emerging markets sold off enough to create value even in a weaker growth environment?